The top law enforcement officials in all 50 states announced an investigation of big servicers of home loans. Servicers receive the payments from borrowers and might also hold the loans. Among the targets of the Attorney General investigations are Bank of America, J.P. Morgan Chase, and Ally Financial. An Ally employee admitted robo-signing thousands of foreclosures each month. The Obama administration has launched its own investigation, but the administration has not supported the idea of a temporary suspension of all foreclosures. Officials say this could endanger the slow economic recovery. 23 states require a court to approve a foreclosure. Several banks have suspended foreclosures in those states temporarily to review their operations. Bank of America, the nation's largest bank, now believes it can restart home repossessions in those states. Robo-signers are not the only concern right now. Putbacks have joined the list of bank worries. In a putback, investors try to force a bank to take back a bad loan. In October, Bank of America said it received a letter from investors holding almost $50 billion in mortgage-backed securities. These are bonds based on large numbers of individual loans. The investors want the bank to buy back any improperly processed loans included in those securities. Demands on banks for putbacks could grow, and there are even questions about who really owns those bad loans. For VOA Special English, I'm Alex Villarreal.
This is the VOA Special English Economics Report. Are you a saver or a spender? A penny saved is a penny earned. This old saying calls attention to the wisdom of saving money. Putting money away for a rainy day is another way to talk about saving for the future. People who hate to spend money are known as tightwads, while those who like to get the most value for their money are called thrifty. A thrifty person is different from a spendthrift. A spendthrift is someone who spends wastefully. People like that are often said to spend money like a drunken sailor, or like there's no tomorrow. In the United States, people who want to start a savings account have different choices of where to put their money. These include banks and credit unions. Credit unions are cooperatives for people who have some kind of connection. For example, the members might work for a university or a government agency. Most credit unions are non-profit organizations. Credit unions, banks, and other financial institutions pay interest on savings accounts, but the interest rates are low. Certificates of deposit pay higher returns. For a certificate of deposit, or CD, a person agrees not to withdraw the money for a certain period of time. This term could be anywhere from a few months to several years. Longer terms and larger amounts pay higher interest. People can withdraw their money early, but they have to pay a penalty. Another way to save is through a money market fund. This is a kind of mutual fund. Mutual funds invest money from many people. The money is sometimes placed in short-term government securities. Money market funds, however, may not be federally guaranteed like other kinds of savings. The Federal Deposit Insurance Corporation guarantees savings up to $250,000. In a number of countries, people have been saving less over the years. The Organization for Economic Cooperation and Development is a group of 34 countries. The OECD says in 1990, Americans had a household savings rate of 7%. This year, that rate is expected to be a little more than 4%. Many European countries have higher rates, but Americans save more than families in countries like Japan and South Korea. For VOA Special English, I'm Mario Ritter. To read, listen, and learn English, go to voaspecialenglish.com. You can also find our captioned videos at the VOA Learning English channel on YouTube.
This is the VOA Special English Economics Report. President Obama turned his attention to financial reform after his victory in March on health care. On April 14th, he met with congressional leaders from both parties at the White House. He said there are some areas on which Democrats and Republicans can agree. If there's one lesson that we've learned, he said, it's that an unfettered market where people are taking huge risks and expecting taxpayers to bail them out when things go sour is simply not acceptable. Treasury Secretary Tim Geithner wrote in the Washington Post that the deep financial crisis is close to the end. But he said the nation must not forget the near collapse of the banking system in 2008 without fixing the causes. He told the American Society of News Editors in Washington that no one is arguing against new financial protections. The debate now, he said, involves how to design a system that lets big financial companies fail without harming the economy. In December, the House of Representatives passed the Wall Street Reform and Consumer Protection Act. That bill would create a new Consumer Financial Protection Agency. It would also increase investor protections and let shareholders vote on the pay of top company officials. And it would create a group to identify and regulate companies that are so big their failure could threaten the economy. Republicans opposed the bill. That was also true in March when the Senate Banking Committee approved its own version. That bill would not create an independent consumer agency, but instead a new office at the Federal Reserve, the central bank. Senate Minority Leader Mitch McConnell of Kentucky said the bill would make future bailouts more likely, not less likely. Both measures in Congress call for a system to supervise derivatives. These contracts are used for different purposes, including investment and protecting against loss. The largely unregulated market in derivatives is estimated at $600 trillion. government rescues of banks considered too big to fail angered the public and helped fuel a conservative movement. The Tea Party also opposes the new health care law and argues for lower taxes and less government. On April 15th, they protested to mark Tax Day, when Americans have to pay any federal taxes they owe. And that's the VOA Special English Economics Report.